Imagine waking up tomorrow to find your car totaled, your phone gone, or a hospital bill so large it wipes out years of savings. One single event, an accident, illness, fire, or lawsuit can undo decades of hard work. This is exactly why insurance exists. Most people buy insurance without truly understanding it, hoping they never need it, yet relying on it when life goes wrong. In this video, I'm going to explain insurance from absolute zero knowledge to full confidence. By the end, you'll understand what insurance really is, why it exists, how it works step by step in real life, what to buy, what to avoid, and how insurance fits into income, investing, retirement, and long-term wealth. Insurance is not about getting rich, it's about not getting financially destroyed. Once you understand that, everything else makes sense. At its simplest, insurance is a system for transferring risk. Instead of one person bearing the full financial cost of a loss, many people share that risk together. You pay a small, predictable amount called a premium, and in return, an insurance company promises to cover large, unpredictable losses if certain events occur. The purpose of insurance is stability, not profit for the buyer. It allows individuals and families to plan their lives without constant fear of financial ruin. Without insurance, modern economies would struggle to function because people would avoid taking risks like starting businesses, buying homes, or even driving cars. Insurance creates confidence by turning uncertainty into something manageable. That core purpose, which is risk management, is the foundation of every insurance product you will ever encounter. Historically, insurance is far older than most people realize. Early forms existed thousands of years ago among merchants who spread the risk of ship losses across many traders. In ancient China, merchants distributed goods across multiple boats to reduce total loss if one sank. In ancient Rome, burial societies pooled money so families could afford funeral costs. Modern insurance developed alongside trade, urbanization, and capitalism because growing economies needed protection from loss. As societies became more complex, risks increased. Fires, accidents, lawsuits, illness, and informal risk sharing was no longer enough. Formal insurance companies emerged to pool risk at scale, backed by contracts and regulation. Insurance grew not because people loved it, but because societies could not function efficiently without it. To understand insurance, you must understand risk. Risk is the possibility of loss combined with uncertainty about when or if it will occur. Insurance only works for risks that are random, measurable, and affect large groups differently. That's why you can insure your house against fire, but not insure yourself against becoming lazy. Insurers use statistics, probability, and historical data to estimate how often losses occur and how severe they are. This process is called actuarial science. The entire insurance industry rests on math, data, and predictability at scale. Individually, losses feel random and emotional, but across millions of people, patterns emerge. Insurance turns personal chaos into statistical order. Let's walk through how insurance works step by step in real life. First, you identify a risk you cannot afford to handle alone, such as medical costs or liability from an accident. Second, you choose an insurance policy that covers that risk. Third, you pay premiums regularly, monthly, quarterly, or yearly. Fourth, if a covered event occurs, you file a claim. Fifth, the insurer investigates to confirm the claim meets policy terms. Finally, the insurer pays according to the contract, minus deductibles or limits. This process may feel bureaucratic, but it exists to prevent fraud and keep the system fair. Every step is governed by the policy contract, which is legally binding. Key insurance terms confuse beginners, so let's simplify them. A premium is what you pay to keep coverage active. A deductible is the amount you pay out of pocket before insurance starts paying. A policy limit is the maximum the insurer will pay for a covered loss. A claim is a request for payment after a loss. Exclusions are events the policy does not cover. Riders are optional add-ons that expand coverage. Underwriting is how insurers assess risk before offering coverage. These terms appear in every insurance product, from health to auto to life insurance. Once you understand them, policies become far less intimidating and you stop relying blindly on agents or advertisements. Insurance exists in many forms, but they all fall into a few broad categories. Personal insurance includes health, auto, home, renters, life, and disability insurance. Business insurance includes liability, property, workers' compensation, and professional coverage. Social insurance includes government programs like Social Security, unemployment insurance, and public healthcare systems. Each category addresses different risks, but the logic remains the same: pooling risk to protect individuals and systems from financial collapse. Understanding which risks belong to which category helps you avoid buying unnecessary coverage while ensuring critical gaps are filled. Health insurance is often the most complex and emotionally charged type. Medical costs are unpredictable, potentially massive, and unavoidable. Health insurance spreads those costs across large populations. You pay premiums, co-pays, and deductibles, and the insurer negotiates prices with providers. Without insurance, even routine care can become financially devastating. Health insurance also has social implications because healthier populations are more productive. However, complexity, cost sharing, and exclusions often frustrate users. Understanding networks, out-of-pocket maximums, and preventive care rules helps you use health insurance strategically rather than reactively. Auto insurance is a legal requirement in most places because driving creates risk not just for you, but for others. Auto insurance typically includes liability coverage for damage you cause, collision coverage for your vehicle, and comprehensive coverage for non-accident events like theft or weather damage. The purpose is accountability and protection. Without mandatory auto insurance, accident victims could be left uncompensated. Your driving history, location, and vehicle type affect premiums because they influence risk. Auto insurance demonstrates how insurance is as much about protecting society as protecting individuals. Homeowners and renters insurance protect your living space and belongings. Homeowners insurance covers the structure, personal property, and liability if someone is injured on your property. Renters insurance covers belongings and liability, but not the building itself. Many people skip renters insurance, thinking it's unnecessary, but it's often one of the best value policies available. Fires, theft, and water damage happen more often than people expect. Housing is usually your largest asset or expense, so ensuring it is essential for financial stability. Life insurance is widely misunderstood. Its purpose is not to benefit you directly, but to protect people who depend on your income. Term life insurance provides coverage for a specific period, while permanent life insurance includes a savings component. For most people, term life insurance is sufficient and cost-effective. Life insurance ensures that death does not become a financial catastrophe for survivors. It is a cornerstone of responsible financial planning for families, even though it's uncomfortable to think about. Disability insurance is one of the most overlooked yet critical forms of insurance. The risk of becoming disabled during working years is higher than the risk of early death. Disability insurance replaces income if illness or injury prevents you from working. Without it, long-term disability can destroy financial plans. This type of insurance highlights a key principle: insure what would ruin you financially. Income is often your greatest asset, and protecting it is essential. Now let's talk about advantages of insurance. Insurance provides financial protection, peace of mind, and stability. It enables long-term planning and encourages economic activity. It allows people to take calculated risks, such as entrepreneurship or homeownership. Insurance also supports recovery after disasters, reducing reliance on charity or government aid. When used correctly, insurance is a powerful defensive tool that complements income and investing strategies. Despite its benefits, insurance has real limitations that people must understand clearly. Insurance does not eliminate risk. It only transfers financial consequences. Premiums can become expensive over time, especially as risk increases with age, location, or lifestyle. Policies often contain exclusions, waiting periods, and coverage limits that surprise people during claims. Some losses may be only partially covered, leaving you to pay the remainder. There is also the risk of overinsurance, where people buy unnecessary coverage that drains cash flow and slows wealth building. At the same time, underinsurance creates a false sense of security. Insurance works best when used deliberately, not emotionally. Understanding these limitations helps you avoid disappointment and ensures insurance supports your financial life rather than becoming a burden. Many beginners make costly mistakes because of common myths about insurance. One myth is that insurance covers every possible loss, which is never true. Policies are designed to cover specific risks under specific conditions. Another myth is that the cheapest policy is always the best option, ignoring deductibles, exclusions, and claim service quality. Some young people believe they don't need insurance, underestimating risks like disability or liability. Others treat insurance as an investment, especially with complex life insurance products, expecting high returns instead of protection. These misconceptions lead to wasted money or devastating gaps in coverage. Insurance should be viewed as a safety system, not a profit tool. Once you understand this, your decisions become far more rational and effective. Insurance is deeply connected to income because your earning ability depends on stability. Health problems, accidents, lawsuits, or disasters can instantly interrupt income flow. Insurance reduces this vulnerability by absorbing shocks that would otherwise derail your finances. Disability insurance protects your paycheck. Liability insurance protects future earnings from lawsuits. Health insurance prevents medical bills from consuming income. Employers understand this connection, which is why many provide insurance benefits. It protects both employees and productivity. Without insurance, income becomes fragile, forcing people to rely on debt or sell assets during crises. When income is protected, long-term planning becomes possible. Insurance does not increase income directly, but it preserves your ability to earn consistently, which is just as important. Insurance and investing work together, not in competition. Investing builds wealth over time, but insurance protects that wealth from sudden destruction. Without insurance, one unexpected event can force you to liquidate investments at the worst possible moment. For example, medical emergencies or lawsuits may require immediate cash, regardless of market conditions. Insurance prevents these forced decisions by covering large losses. This allows investments to compound uninterrupted. Many people mistakenly choose between investing and insurance, but the correct approach is balance. Insurance handles low probability, high impact risks, while investments handle long-term growth. When aligned properly, insurance creates the stability that investing requires to succeed over decades. Taxes interact with insurance in ways many people overlook. Some insurance premiums, such as certain health or business policies, may be tax deductible depending on jurisdiction. Some insurance benefits, like life insurance payouts, are often tax-free to beneficiaries. Other products, such as annuities or cash value life insurance, may offer tax deferral advantages. However, tax rules vary widely and change over time, making blind assumptions dangerous. Understanding tax treatment helps you choose policies that align with your financial strategy rather than accidentally creating tax inefficiencies. Insurance should never be purchased solely for tax benefits, but ignoring tax implications can quietly reduce long-term outcomes. Awareness improves coordination between insurance, income, and investment planning. Retirement planning depends heavily on insurance because aging introduces new risks. Longevity risk, the chance of outliving your money, is one of the greatest retirement challenges. Healthcare costs typically rise with age, and investments alone may not cover unpredictable expenses. Insurance products like health coverage, long-term care insurance, and annuities address risks that markets cannot fully manage. Social insurance programs also play a role, though they are often insufficient on their own. Without insurance, retirement plans rely entirely on market performance, which introduces vulnerability. Properly integrated insurance creates stability, ensuring income continuity and protection against catastrophic expenses. Retirement without insurance is not planning, it is hoping. Insurance raises ethical questions about fairness, access, and pricing. Risk-based pricing is necessary for insurers to remain solvent, but it can exclude high-risk individuals or make coverage unaffordable. Society responds through regulation, subsidies, and shared risk programs. These ethical tensions shape health insurance, disability coverage, and social insurance systems worldwide. Insurers must balance profitability with social responsibility, while governments balance fairness with sustainability. Understanding these dynamics helps explain why insurance systems differ between countries and why reforms are controversial. Insurance is not just a financial product, it reflects societal values about responsibility, protection, and collective risk sharing. Psychologically, insurance has complex effects on behavior. On one hand, it reduces anxiety by providing security against loss. On the other hand, it can encourage riskier behavior, a phenomenon known as moral hazard. People may drive less carefully, neglect health habits, or take financial risks because they feel protected. Insurers attempt to counter this with deductibles, co-pays, and monitoring. Understanding the psychological dimension helps you remain disciplined. Insurance should support responsible behavior, not replace it. When used correctly, insurance reduces fear without encouraging recklessness. Awareness of these psychological effects improves decision-making and keeps protection aligned with long-term goals. Insurance needs change as financial knowledge and life circumstances evolve. Beginners should focus on essential protection, health insurance, basic property coverage, liability insurance, and income protection. The goal is survival and stability. Intermediate users refine coverage by adjusting deductibles, comparing providers, and optimizing cost efficiency. Advanced planners integrate insurance with estate planning, business succession, tax strategies, and wealth transfer. At every stage, insurance should match current risks rather than past assumptions. Treating insurance as a static decision leads to gaps or waste. A structured progression ensures coverage grows more sophisticated as financial complexity increases. Not everyone needs every type of insurance. People without dependents may not need life insurance. Those with strong emergency funds may self-insure small risks. Very low probability, low-impact events often don't justify premiums. The guiding principle is simple. Insure risks that would cause financial ruin and self-insure manageable losses. Avoiding unnecessary insurance frees cash for saving and investing. However, avoiding essential insurance exposes you to irreversible damage. The challenge is judgment, not avoidance. Thoughtful selection, rather than blanket buying or total rejection, leads to the best outcomes. Best practices make insurance effective rather than frustrating. Always read policies, especially exclusions and limits. Review coverage annually or after major life changes, such as marriage, children, relocation, or career shifts. Compare multiple providers, not just prices, but claim handling and reputation. Keep documentation organized and accessible. Understand deductibles and ensure you can afford them in emergencies. Insurance should evolve with your life, not remain frozen. Treating insurance as an active system rather than a one-time purchase dramatically improves its reliability when you need it most. Insurance companies are businesses, not charities. They make profits by managing risk efficiently, pricing accurately, and minimizing unnecessary claims. This reality explains underwriting, exclusions, and claim investigations. Understanding this removes emotional frustration and sets realistic expectations. Insurers are not adversaries, but they are not personal guardians either. They operate within contracts and regulations. When you understand their incentives, you interact more strategically, choosing appropriate coverage, documenting claims properly, and avoiding misunderstandings. Clear expectations lead to smoother outcomes for both sides. Insurance fraud undermines the entire system. False claims increase costs for everyone through higher premiums. This is why insurers invest heavily in verification and why laws strictly punish fraud. Regulation exists to protect honest participants and maintain trust. Consumer protection laws also prevent unfair denial of legitimate claims. A stable insurance system depends on honesty, transparency, and enforcement. Understanding this legal structure helps explain why claims processes can feel strict but necessary. Trust is the foundation of insurance, and fraud erodes that foundation rapidly. Technology is transforming insurance through data analytics, automation, and personalization. Insurers now use sensors, health data, and algorithms to assess risk more precisely. Claims are processed faster, but privacy concerns grow. While technology increases efficiency, it also raises ethical questions about surveillance and fairness. Understanding insurance fundamentals allows you to evaluate these innovations critically rather than emotionally. Technology changes delivery, not purpose. The core logic of risk pooling remains unchanged even as tools evolve. Insurance is rarely exciting, but its power lies in what it prevents. Its value is invisible during normal times and undeniable during crises. People often regret insurance only after a loss occurs. That regret comes from misunderstanding its purpose. Insurance is not meant to feel rewarding. It is meant to feel reassuring. When viewed correctly, insurance supports confidence, planning, and long-term decision-making. Its quiet role is what makes it effective. Perspective determines how insurance feels. When seen as a cost, it feels wasteful. When seen as protection, it feels empowering. Insurance is neither good nor bad. It is a tool shaped by how you use it. The same policy can be a burden or a safeguard depending on understanding and alignment with goals. Clarity transforms resentment into strategy. This shift in mindset is essential for effective financial planning. When you truly understand insurance, what it is, how it works, its limits, and its role, you stop guessing and start planning. Insurance becomes a deliberate part of your financial system rather than a confusing obligation. It protects income, preserves investments, stabilizes retirement, and supports long-term goals. Mastering insurance does not make life risk-free, but it makes risk manageable. And that understanding is what turns financial uncertainty into confidence and resilience over time.